Most traders try to solve their problems by finding new patterns and trading new patterns. And I'm here to tell you that patterns can solve a lot of your problems. They allow you to manage risk and have an expectation of what may occur. But the problem with patterns is they don't actually work. And the reason that is because there's a failed pattern for every successful looking pattern. So successful head and shoulders, it's always going to have a failed head and shoulders. Successful breakout, it's always going to have a failed breakout, and so on and so on. So the key actually isn't the patterns. We're going to talk about what the key actually is today, and we're going to teach you how you can use that in your trading next week. So if that sounds good, stick around. My name is Alex, and this is The Strat. So the first thing is we want to make a distinction between what a pattern is and what a phenomenon is. So a pattern is defined as something that repeats the same way over and over again. So it's like a rules-based set that tells us what's going to come next. So you can see red, blue, red, blue, red, blue. It's like, what's the next color? Red after blue, and then after red is blue. So it's really simple. That's what a pattern is. If this, then this happens, always. And this is important because when you trade patterns, like I just told you, the head and shoulders, if it sets up and people say that's a pattern, it means that it has to successfully break out every time. But we know that's not the case. So that actually tells us that those are not patterns per se. They're just phenomenon where you can see this type of pattern that may or may not work. So what is a phenomenon? So a phenomenon is different from a pattern. And this is just simply something that happens. So a phenomenon just happens, which means like a volcano erupting. It's a natural phenomenon. It's just something that happens with volcanoes in nature, or a solar eclipse. The moon blocks the sun. It's just a phenomenon that occurs. So when we see an event or a thing that occurs, that is considered a phenomenon. So if we're talking about a chessboard, it goes white, then black, then white, then black. That's a pattern. The fact that a chessboard exists is a phenomenon. And the difference is a phenomenon doesn't always happen, but it just happens. And hopefully I'm not too confusing here. I'm going to show you in the charts why this is super important to traders. The reason this is important to traders is because there is a phenomenon that occurs in the charts that is going to tell you what's coming next potentially. And because it's a phenomenon, it doesn't always occur. But when it does, I can tell you, you can be sure that it's going to help make you money. So what it is this. When a bar fails one side of a range and goes the other way, it's attempting to take the other side. And make sure my words are clear. Attempting, right? It doesn't always do it, but when it does, it works very well. So how does that look in a chart? Well, the simple sentence is if you fail one side of the range, you're attempting to take the other. So in this case, we're looking at a weekly chart of the Dow Jones. You'll notice we take last week's lows and then come back into the range. What that tells us is when this is down, but it's green, going back through the previous week's range, it's trying to take the other side of that. And the phenomenon is that this occurs. We make a new low followed by a new high. So the reason this is useful is because it allows you to gauge magnitude or where price is trying to go. So in this case, anytime this is green on the week after taking last week's lows, it's trying to take last week's highs. And you can see we can gauge that target and say that's a 3% move. We would like to know about that. And the reason that we can say this is because this is one of the three things price can do. So for example, we're going to talk about the other two things it can do, and you're going to get a very clear picture of what we're looking for. So the first thing price can do, we call it scenario one. It's the first thing it can do, is go inside. So you'll see this makes a lower high to the previous range and a higher low to the previous range. This is inside, it's doing nothing because you're noticing it's not taking either side of this previous bar. We call it scenario one, inside bar. We can also have scenario two. So in this case, you'll see a lower high and a lower low to the previous bar's high and previous bar's low. That's a two to the downside. And this is a downtrend. It's making a lower low, lower high. So it's going down. In this case, you can see it did take out one side of the range and fail, but it did not successfully take the other side out. The new bar opened, went two to the upside because it was a higher high, and it did have a higher low at one point because it was green, taking last week's highs. And then it failed by going red, which tells us what? It's going to try and take out both sides of this range, which it does successfully. Then it does it again this week. So hopefully you can see that. So we have a scenario one, a scenario two, which can be down or up, and then the scenario three, which takes both sides. And the cool thing is threes don't just happen. you have to have a scenario 2 first that fails, meaning a 2 up that goes red, or a 2 down, in this case, that goes green. That has to happen first. So when this goes 2 down but green, we know it's attempting to take the other side. So hopefully that all makes sense. Now I'm going to show you how you can implement this idea and this methodology into your own trading. So given that there's only 3 scenarios, the 1 inside bar, the 2, which is directional up or down, and the 3, which is a failed 2 that goes 3, there's only so many ways price reverses. And all of those ways are going to have that failing one side of the range and taking the other side for the most part. So for example, this is the most common reversal you're going to see on the charts. We call it the 2-2 reversal. So you can see in this case, price was going down, then it made a new low and then goes green. Where is it going to go? This green line. We're looking to take that out. So when it closes out, since this was a lower high and a lower low, it was going down. Now above that high, it's going reversal with a higher low and a higher high. And then it continues higher, where you're going to see we make a new high to this previous bar and a new low. So you can see we're using that outside bar to gauge where price is going. This is just 2 bars instead of 1. And this will go both up and down. And we're going to see there's a lot of variations of reversals you can have. But the simple thing that you need to understand is if you take one bar range or one side of a bar's range and fail, it's going the other way. So we're going to talk about the 2-2 reversal today. And I highly suggest if you're new or you're struggling with trading, just do this because there's so many setups. And I'll show you those setups at the end of this video that we have taken in the past week. So here it is. If we go to the US 500, which is your ES futures, they're going to look the exact same pretty much. What we're going to notice is Monday. So you'll notice Monday takes out last week's lows, which is Friday's lows here, and then closes back into the range. So what we would say is as long as we're above this low, we would like to see the other side of that taken out because we'd made a new low and we failed closing back in for our 2 down, 2 up reversal. So you will notice they go higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. So this goes reversal, lower highs into higher highs, and it keeps making higher lows. It has not reversed yet. So what we consider that is still good, meaning if you bought it anywhere in here, you can continue to hold until it reverses against you. And that's super cool to know about. So the next thing is we can look left. And this is not a pattern per se, but it's with that idea of the phenomenon. What you'll notice is this. If you go to a weekly chart, what happened? Well, we had, and I actually want to go to the US 500. It's just going to look a little cleaner here. But we had this. You'll see we had multiple bars stuck inside of this previous bar here. We prefer not to trade in that because it's going to go up and down and up and down and up and down because these are all inside bar to this bar, which is this. You'll see we have a lower high and a higher low to this bar's range. They did make a new low going 2 down, but we still have a higher low and a lower high to this bar's range. And then here, we still have a higher low and a lower high to the previous bar's range. So you'll notice these 3 bars are an inside bar to this bar. Then it makes a new low and comes back in. Now, if that works, we may take out the other side of this range because we know if we make a new low and fail, it's going to the other side. So this is the one pattern if you're going to use this with your 2-2 reversal, I would suggest doing. Because now when we go and take a look at the daily chart, it's extremely obvious what happened. We made a new low and then it reversed in here, setting up your 2-2 reversal. And now it's trying to take this stuff out if it doesn't reverse back down. Super, super simple. So hopefully that makes sense. Now I'm going to show you a few other examples just to solidify this concept so you can bring it into next week's trading. And I'm going to show you one that fails to completely take out the other side of the range. And we're going to talk about how we manage risk in order to make sure we still come out on the winning side. So for example, you're going to see the same thing, except much more bars on a 15-minute on coin here. So it goes completely inside. All of these bars are scenario 1. 2, this bar's range here. So you'll notice lower high, higher low, all the way through this until right here. So when it takes this out, the second that happens, you can go to a lower time frame if you'd like and look for reversals here. Because if those reversals are successful, we know we want to take the other side of this out and then ideally take out the new highs. So if we go down to like a 5-minute chart, what you're going to see is exactly the setup you are looking for. You'll notice we make a new low and then we go close back into the range. What is that? That is your 2-2 reversal, right? Setting up to go and take this out for sure, as long as that is above the high of this bar here. So what we say is if that works, and we go to take this out, 295.33 just about, 295.36, then what's the next 2-2 reversal? Well, on a 15 minute, the next 2-2 reversal is here. So we can actually add to the winning position, entering here and then buying more here. And then how do we trail our stops? Well, there's two ways to do it. What we want to do is always move stops toward price. We should never move our stop away because risk management is actually what keeps you from being a losing trader. So if we bought our positions here and we know this is our first target, target 1, and this is our second, once we take out the first target, we can either decide we're going to bump our stops up against these lows all the way, just walking our stops up the higher lows until it reverses right here. And you can see it goes back the other way. Or we can say price must stay above this. So we can have a stop either right there, or we can have our stop just slightly below it to give them some wiggle room if they wanted to retest it. So that's the two ways we want to do it. So if we were to go in here and show you how we would prefer to manage this trade, it would look like this. We'd look to enter long here. And some traders will opt for a much tighter stop. They will go in here and they will do some battle, maybe entering, stopping out a few times until it goes right away, and then you're in with a nice tight stop. Some traders will decide to risk this low, or even just risk the levels that we reclaimed or closed back above over here. And then what you can do is, like we showed on the 15, walk your stop up. So if our target would be this, we'd want to walk our stop up these levels. This would be where we definitively have to get out when that 15 reverses. And if we are going to bump our stop up into this high here, notice once it closes above that, what we can do is move our stop to here. And we can take, a 1 to 4. And if you have the wider risk, just about a 1 to 2.8, 1 to 3. And the cool thing is once you learn how to add to positions, risk reward no longer matters to you. Because if you add to winning positions and cut positions that are losing, or AKA going reversal against you, then you're not going to be in losing trades. So if you're always in a winning position, there's no risk reward. You're always playing with house money. Because if I buy this and it goes up, $2 here, I can buy another 100 shares risking 20 cents a share, and not, or I said it'd be 2 cents a share, right, to risk $2. But we can do stuff like that where we risk their money. So we can add to positions, keeping our cost basis below where we're in, and therefore lowering our risk. We're not going to dive too much into that today, but hopefully that makes sense for those of you that are inclined to do that. We have one more example, and then we're going to end off the video. I have something really cool to share with you, so stay to the end. So I just want to show you the idea of how this can work. So if we look at PTLO here, this is a 60-minute chart. You will notice we had 1, 2, 3 bars stuck inside of this bar here. So you'll notice we're closer to a 2-2 reversal. If this were to break, it would take this out. And then we ask, what would that do? We would reclaim back into this bar's range, looking to take the other side of that. And then potentially we go and take out the complete other side of this range, because you also have this bar we are stuck inside that's also going to be reclaimed at that same level. So we look for that 2-2 to set up. And then you will notice right at 231, it went 2-2 reversal. So if we go and take a look at PTLO on a 60-minute basis, instantly in a winning position, you buy it and it instantly goes. These are what the best trades will do. And when that occurs, you'll notice we reclaim this low. Anytime above this, 1160. So therefore we can look for 1192. And if we go to a 4-hour chart, you'll notice on the 4-hour chart, we also on a bigger time frame reclaim this level. So the biggest thing, and I actually want to show you one more example, so forgive me, but I want to show you one more example. The biggest thing is we want to do this at higher time frame areas where we can get a much bigger target. I'm going to show you one last one here. Most traders will not use quarterly, yearly, even monthly charts at times. And they're actually really important because from what you've noted and learned here, you'll notice if we reclaim, in this case, a quarterly range, and this range is $11 or 166% off the lows, that's something you want to know about, because if this happens and we're coming back through here, it's going to take that out. So when you use higher time frames, it allows you to go for much bigger moves, and it's super important to know that. So what we want to do is look for higher time frames first, right? We look for this to set up first, closing back in for the 2-2 reversal to take this out. And then when we go to a lower time frame, we use that same idea, the same technique in order to enter that trade. So we can look for, you can see we make some slight lower lows. Here's our 2-2 reversal here. We can buy it there first, right? And then you'll see the mother bar, which is that bar we get stuck inside of. 1, 2, 3, 4 bars inside of here, followed by the new low, and then we close back in. Where's that going to go? Here. So you can see it's fractal in nature, where you're going to do this on a big time frame, then drop it down lower to get lower risk entries into your trades. So hopefully that makes sense and you can see where we're going with this. And if you're interested in more stuff like this is where I'm going to show you something really cool. So if you go to the top link in the description, it's going to be learnthestrat.stratalerts.com/learnstrat. And if you're watching this video in the future, this website or URL may be changed, but it's still going to be active. You can go there and you can reserve your spot on our free newsletter. And this is where videos like this are posted weekly. We normally try to keep them to 10 minutes so people can learn at a slower pace. And the videos are just jam-packed with a ton of information and knowledge about the strat and about trading, just like this video. So if you like this type of thing, go and check it out. And the last thing is, if you do check it out, we can send you some stuff normally when you join it. And the creator of the Strat, Rob Smith, has some course materials that I normally send out to people who have just joined. So go and check it out. You're going to be the first to know about anything we're doing as well on top of that. So it's really useful and great for people learning the Strat. If you enjoyed this video, let me know by liking the video, dropping a comment below if you want other topics covered. And that's all I've got. So enjoy the rest of your day, and I'll see you guys in the charts.